So imagine you are doing everything perfectly on the factory floor. You strategize, you engineer this brilliant new product, and you actually manage to boost your revenue by like a staggering 21% right in the middle of a massive market slowdown.
Right.
You're just completely crushing the competition. And then a politician in New Delhi signs a piece of paper and instantly, 12 crore rupees are just wiped off your balance sheet for the quarter.
Yeah. It's basically the ultimate paradox of running a modern industrial business today. You can master the physics of manufacturing, but you still have to survive the gravity of macroeconomic regulation.
Exactly. And welcome to this deep dive, because today that is exactly what we are exploring. We're looking at the current landscape of the Indian automotive sector for you, and we're doing it by zooming from the absolute macro level, so the broad view of the entire market, straight down into the micro level financials of one very specific, highly revealing component manufacturer.
Automotive Axles Limited.
Right, Auto AXLs.
And our mission here is to uncover how big-picture market trends and, sweeping government regulations directly dictate a single company's day-to-day operations, their financial reality, and ultimately the kind of drastic changes their leadership makes behind closed doors.
Yeah. To do this, we've pulled together a really specific stack of sources for you today. We're looking at a detailed technical chart analysis of the Nifty Auto Index running up to March 2026. We are also analyzing a full 12-month news coverage sweep of Auto AXLs. And maybe most importantly, we are tearing into the company's official Q3 financial outcome and their board meeting documents from February 4th, 2026.
But, before we get into the company itself, we really have to start with the macroeconomic weather.
Right.
Because before we can judge how Auto AXL is navigating the road, we need to know if the road itself is watching out entirely. And that requires looking at the Nifty Auto Index, ticker symbol CNXA UDO.
Okay, so looking at the technical chart for the Nifty Auto Index up to March 2026, it shows this massive medium-term uptrend starting from early 2024, peaking somewhere in that 25,000 to 27,000 zone.
Yeah, it's a huge run.
It really was. But recently, the chart shows a pretty notable pullback. The index is resting near what technical analysts call the 200-period exponential moving average, or the EMA, which is sitting right around the 23,000 mark right now.
Right, and that 200-period EMA is essentially the structural bedrock of the market. It represents the historical average price over the last 200 periods, but it's weighted slightly toward recent action. So when an index falls from 27,000 and hits that 23,000 line, you're essentially watching the market test its own foundation.
Okay, I understand the idea of a foundation, right? But the sources show short-term indicators that look like a dashboard completely lit up with red warning lights.
Yeah, the short-term stuff looks a bit scary.
It does. The relative strength index, the RSI, is nearing oversold territory at 37. The MAD is sitting in negative territory at minus 71. And the stochastic oscillator is overbought at 97. If, 11 out of 12 short-term moving averages are flashing a sell signal, and the MACD is way down at minus 71, how can the primary trend in the sources still be confidently called bullish?
Well, the key there is really understanding the mechanics of what an indicator like the MACD is actually measuring.
Okay.
Because a MACD, which stands for Moving Average Divergence, it does not measure the absolute price of the stocks. It measures the distance between a fast short-term moving average and a slow long-term moving average.
Oh, I see. So a reading of minus 71 just means the short-term sentiment has violently disconnected from the long-term reality.
You nailed it, yeah. When the MACD hits minus 71, it's just telling us that recent sellers have been basically panic dumping over the last few weeks.
Right.
And that drags the short-term average way down below the long-term average. It's a measurement of sudden downward momentum, not permanent structural damage. Think of it like a rubber band that's been stretched really tightly to the downside.
Okay, that makes sense.
As long as the price holds above that 200-day EMA bedrock of 23,000, the broader multi-year trend remains entirely intact. The big institutional holders aren't really selling. It's mostly just short-term traders clearing out.
That makes the 17.5% weightage of a massive company like Mahindra and Mahindra in this index make a lot more sense, too.
Exactly.
If the heavyweights aren't breaking through the floor, the whole sector is really just catching its breath. But And this is a big, but this consolidation phase does have real-world consequences.
Absolutely, it does.
The macro environment cooling down has led to a forecasted 2 to 3% demand drop in medium and heavy commercial vehicles, the MHCV space, for fiscal year 26.
Which logically means fleet operators are delaying their purchases of new heavy trucks.
Yeah.
I mean, if you run a logistics company and the broader economic momentum is stalling out, you do not go and take out massive loans to buy a whole fleet of brand new vehicles.
Right, you make do with what you have. So if fleet operators are being cautious, you would naturally expect a component manufacturer who relies on selling parts for those new trucks to be struggling right alongside them.
You would think so, yeah.
If the MHCV market is shrinking by 3%, a company making commercial rear axle assemblies should realistically be posting negative numbers.
Right.
But when you look at Auto AXLE's Q3 FY26 results, the quarter ending in December 2025, their revenue actually rose to 562 crore rupees.
It's wild.
It's a 21% jump quarter over quarter and 6% year over year. And they are running their manufacturing capacity at a super healthy 80%.
It represents this really fascinating operational divergence from the sector trend. I mean, they're growing while their primary market is actively contracting.
Yeah, and this tells me they aren't just relying on legacy contracts. In a down market, fleets aren't buying new trucks, but they are trying to squeeze more life and more profit out of their existing runs. So they must be looking for specific efficiency upgrades. And the sources highlight that Auto 8XLES growth is heavily driven by the ramp-up of a specific new product, the MS-185 axle.
Yeah, the MS-185 axle is really the perfect example of achieving product-market fit during an economic tightening. Because, an axle is not just some dumb piece of metal that connects the wheels.
Right, it's a lot more complex than that.
Exactly. It is a critical component of the drivetrain. The efficiency of the axle basically dictates how much engine power is lost to mechanical friction before it ever even reaches the tires.
Oh, wow. So a better axle literally translates to better fuel efficiency.
Fuel efficiency, yes. And just as importantly, load-bearing capacity. When a logistics company is facing tight margins, their profitability really comes down to their payload-to-weight ratio.
Makes sense.
Like how much freight can this specific truck haul per trip, and how much diesel is it going to burn while doing it? The MS-185 is engineered specifically to carry heavier loads with less of that parasitic power loss.
So Auto AXLs realize that even if fleet operators aren't buying entire new fleets of trucks, they will absolutely still pay a premium to retrofit or upgrade to an axle that actively reduces their daily operating costs.
That's the brilliance of it. They recognized the macro environment was forcing their customers to prioritize efficiency over expansion. So they engineered the exact component to deliver that efficiency.
They basically captured a larger slice of a shrinking pie simply by having a superior, highly relevant product ready to go.
Yeah, and that strategic foresight is exactly why their capacity is humming at 80% and their revenue spiked by 21%. Operationally speaking, they read the market perfectly.
Which brings us back to the paradox I mentioned at the very beginning of this deep dive.
Yes, the pothole.
The massive hidden pothole. So they engineered the perfect axle, they sold it aggressively in a really tough down market, and they booked 562 crore in revenue. But when you look down at the net profit for Q3, it sits at just 38.81 crore. And the reason it's that low is due to this massive, exceptional item loss of roughly 12 crore rupees.
Right. And an exceptional item on a balance sheet is essentially a red flag waved by management to say, hey, look, this massive charge is an isolated event. It is not a reflection of our core business operations.
But the source of this 12 crore hit is what's so jarring. It wasn't a supply chain collapse. It wasn't a factory fire.
Yeah.
It was the Indian government's November 21st, 2025 notification of the new consolidated labor codes. The government basically merged 29 existing labor laws into 4 unified codes covering wages, industrial relations, social security, and occupational safety.
And the mechanism behind this financial hit is rooted entirely in accounting standards and the legal redefinition of compensation.
I really have to push back on the sheer scale of this, though. I mean, how does a company seamlessly manufacture heavy industrial components, navigate a shrinking market, and then suddenly lose 12 crores in a single quarter just because of a paperwork and legal definition change in New Delhi? It feels entirely divorced from the reality of running a factory.
Well, it feels divorced, sure. But legally, the balance sheet and the law are inextricably linked. We have to look at this neutrally, strictly through the lens of compliance.
Fair enough.
The new labor codes established a uniform, standardized definition of what constitutes wages across the entire country.
Meaning previously, different laws defined a worker's base pay differently.
Yes, exactly. Previously, companies might structure compensation with a much lower basic wage and then heavily pad it with various allowances. But the new code dictates that basic wages must make up a specific, significant percentage of the total compensation.
So it changes the baseline mathematical formula for how you calculate literally everything else.
Yes. And the most critical everything else in India is gratuity.
Okay, gratuity. Explain that for us.
Gratuity is a statutory lump sum paid to employees who have served for 5 continuous years or more when they eventually leave the company or retire. And it's calculated based on their final drawn basic wage multiplied by their years of service.
Ah, I see the trap now. If the government suddenly forces you to reclassify more of an employee's total pay as their basic wage, the formula for their gratuity payout just instantly inflates.
It inflates drastically. And this is where the accounting principle of past service costs kicks in.
Past service costs?
Yeah. Imagine a worker who has been on the factory floor for 15 years. Auto AXLES has been keeping a liability on their books for 15 years of expected gratuity, but it was based on the old lower wage definition.
Oh, wow.
So the moment the new labor code was notified on November 21st, the legal obligation for all 15 of those past years instantly increased.
The company literally owes more money for work that was completed a decade ago.
Yes, and under strict accrual accounting standards, you cannot just wait and pay that extra money when the worker retires in 10 years.
You have to claim it now.
Right. The moment the liability becomes a legal reality, you must recognize the expense on your profit and loss statement immediately. So the company's finance team ran the new math and realized the extended definition increased their total liability for gratuity and leave by roughly 12 crore rupees.
So they didn't actually write a physical check for 12 crores to their employees that quarter.
No cash actually moved.
They just had to officially recognize the newly created debt on their books, which just crushes the quarterly profit on paper.
Exactly. It updates the financial map to reflect the new regulatory terrain. The cash hasn't left the bank, but the liability is now fully accounted for. It is painful for the Q3 optics, obviously, but it ensures the balance sheet is bulletproof moving forward.
Well, taking a 12 crore regulatory hit on the chin like that requires a company to be incredibly resilient.
Definitely.
And the sources indicate Auto AXLES is not just absorbing the blow. They are aggressively pivoting to capitalize on the future. Analysts are forecasting a 5 to 10% industry recovery in FY27 as the macro environment starts to stabilize. To meet that, Auto AXLES is executing a 120 crore CapEx modernization plan.
And a 120 crore capital expenditure for a component manufacturer that signals a major shift. That's moving from just maintaining current operations to actively building next-generation capacity.
Right. But throwing 120 crores at new machinery isn't enough on its own. You don't spend 120 crores upgrading the race car's engine without also changing out the pit crew.
That's a great way to put it.
And this leads us to the February 4th, 2026 board meeting. They didn't just approve the financials. They executed a massive sweep of their senior management personnel.
Yeah, the leadership changes were significant.
Very. Mr. Raman K stepped in as the interim CFO. But more tellingly, the general manager of general maintenance and the general manager of quality assurance both departed.
Well, replacing legacy operational roles is pretty common during a major modernization push. But who they actually hired to fill the void reveals their entire corporate strategy.
Let's talk about those hires. They brought in Mr. B. Vishwas as the executive manager of IT and Mr. C. Jagadish Talvachar as the senior general manager of strategic sourcing.
Okay.
When I look at Mr. Vishwas's resume, 25 years of IT experience, SAP implementation, Cisco Meraki network upgrades, and he's a certified lead implementer for ISO 27001 information security.
Right.
Raises eyebrows. And Mr. Taluvachar brings 24 years focusing specifically on supply chain transformation and digitalization. What is your read on those specific skill sets for an axle company?
Well, what does it sound like to you?
Honestly, it sounds less like they're running a steel foundry and more like they're building a firewall around a blast furnace.
Exactly.
You don't hire a Cisco Meraki and ISO 27001 cybersecurity expert to oversee guys welding metal. You hire them because the 120 crore capex means the new factory floor is going to be entirely digitized and connected to the cloud.
That deduction is spot on. This is the transition to Industry 4.0.
Yeah.
Modern heavy manufacturing is no longer purely mechanical. It is inherently digital. If you spend 120 crores on state-of-the-art robotic assembly arms and automated quality control sensors, Those machines need massive network bandwidth to communicate with each other in real time. That is exactly why you need the Cisco Meraki network upgrade.
And what about the ISO 27001 certification? Why is that so crucial here?
Because ISO 27001 is the global gold standard for information security management.
Right.
Look, if your entire factory floor is connected to the internet, it is vulnerable to cyber attacks.
Ah,
A ransomware attack on a modern auto component manufacturer doesn't just steal some data. It physically locks the robotic welding arms and halts the assembly line dead in its tracks.
that would be devastating.
It would be. And analysts are forecasting a 15.2% return on equity for auto AXLEs. You cannot protect that kind of profitability if a digital breach shuts down your production for 3 days.
Right.
So the IT hire proves they view cybersecurity as a core operational necessity, not just an afterthought.
And the strategic sourcing hire fits right into that digital ecosystem too, doesn't it? Because supply chain digitalization isn't just like emailing purchase orders faster.
No, not at all.
It means setting up API integrations with your steel suppliers so your automated assembly line can dictate exactly when raw materials arrive down to the hour.
That is the absolute essence of modern margin protection. By syncing the digital supply chain with the factory floor, they minimize warehouse storage costs and they completely eliminate production bottlenecks.
It's so smart.
It is. They completely swapped out traditional maintenance and quality assurance heads for digital infrastructure and digital sourcing experts. The boardroom is basically ensuring the human capital perfectly matches the new 120-core mechanical capital.
Wow. Okay, let's zoom back out and look at the whole picture we've covered today for you. We started by looking at the Nifty Auto Index resting cautiously on its 200-day moving average bedrock, flashing negative short-term NCD momentum as the broader market kind of caught its breath.
Right, the macro view. And from there, we zoomed into how Auto AGX actually defied that broader 3% market contraction, driving a 21% revenue surge by engineering the MS-185 axle.
Which was a product specifically designed to offer fleet operators better fuel and load efficiency when money is incredibly tight.
Exactly.
Then we explored the massive hidden pothole, how the government's consolidation of the labor codes redefined basic wages, instantly forcing the company to recognize a 12 crore past service cost for gratuity liabilities, taking a big chunk out of their Q3 profit.
And finally, we saw how the company's responding to that complex environment by investing 120 crores in a completely digitized factory floor, protected by top-tier cybersecurity and supply chain leadership, readying themselves for the FY27 recovery.
All of this fundamentally changes how you should consume financial news. I mean, the next time you see a company report an unexpected quarterly loss, or you see a heavy industrial firm shaking up their IT department, you won't just take the headline at face value.
You really can't.
You will dig into the why. You will look for the regulatory change hiding in the footnotes, or the digital CapEx strategy driving those executive hires.
It really does raise one final crucial question that I think you should mull over long after we sign off today.
What's that?
We began by looking at the technical chart of the Nifty Auto Index. You know, the moving averages, the mathematical momentum, all the trends that thousands of traders rely on to predict the future value of a stock.
Right.
But if a single sudden administrative update to a labor code can instantly wipe 12 crore rupees off a fundamentally successful company's balance sheet, how much of a stock's technical chart is actually driven by the physical operational reality of the business versus the entirely unpredictable stroke of a lawmaker's pen?
Man, that is the ultimate blind corner.
It really is.
You can engineer the most efficient axle, you can digitize your entire supply chain, and secure your factory with the best IT talent in the world. But the regulatory environment can still just rewrite the math overnight. Thank you so much for joining us on this deep dive. Keep asking those hard questions, keep looking past the obvious headlines, and we will see you on the next one.